On paper, ACL Plastics is a manufacturer. Simple, right? Well, not so fast. If you follow the money, a totally different picture emerges, something that's been hiding in plain sight.
Okay, let's cut right to it. This is the number that changes everything, 27%. More than a quarter of ACL's net profit has nothing to do with selling plastics. Nope, it's all finance income. Basically, money they're making from their huge pile of cash and investments.
All right, before we dig any deeper, just a quick heads up. This is all based on my personal opinions, and it's for informational purposes only. Definitely not financial advice. Also, you'll see some adjusted data here, which comes from my own proprietary models, so it might look a little different from the official company statements. So, with that out of the way, let's look at the P&L. At first glance, things look great. The company's profitability seems to be soaring. But, the story is never quite that simple, is it? And here's why things look so good. The revenue, it's up nearly 14%. But here's the kicker. The cost of actually making their products only went up by about half that. Whenever you see a gap like that open up, where your sales are growing way faster than your costs, that's a telltale sign of some serious pricing power. And what happens when you combine those two trends? Boom! A massive 32.7% jump in gross profit. I mean, that's an incredible number. But, and this is a big but, profit is only one piece of the puzzle. The real story, the secret, is buried in the balance sheet. So let's go there. Let's look at the balance sheet, because this is where we uncover what this company really is. Wow, just look at this. 51%. More than half of everything this company owns is just sitting in financial assets. Cash, investments, you name it. Any actual manufacturing stuff, the factories, the machines, that's only 19%. This isn't your typical manufacturer. It's starting to look a lot more like a hybrid, part plastics company, part investment fund. So you have to ask, right? With a structure like this, how are they actually managing their day-to-day cash? How does this affect the nuts and bolts of the business? Well, it's a real tale of two trends. On the plus side, they're doing a fantastic job managing their inventory. It's down 21%. That's super efficient. But here comes the warning sign. Their receivables, which is just a fancy way of saying money customers owe them, have shot up by 31%. So they're great at selling stuff, but they're getting really slow at collecting the cash for it. And that right there, that creates a huge problem. It leads us straight to the final piece of this puzzle, the disconnect between profit and actual cash. Let me walk you through how this plays out. They start with a nice, healthy net profit of over 352 million rupees. Looks great on paper. But then, almost all of it, a whopping 277 million, gets stuck in those unpaid invoices. So what's left over? What actually hits the bank as operating cash? A measly 144 million. A huge chunk of their profit just vanished before it became real money. This all boils down to a really important number called the cash conversion ratio. And for ACL, it's just 41%. Let's put that in plain English. For every single rupee of profit they reported, they only managed to turn 41 cents into actual spendable cash. That is a serious disconnect. So what are the big takeaways here? What can we learn from this? I think there are three really important lessons. And by the way, if you're getting value out of this kind of analysis, do me a favor and hit that like button and subscribe. It really helps the channel and you won't miss the next breakdown. Okay, lesson one. Just because a company is sitting on a mountain of cash doesn't mean it's a growth machine. Sometimes it just means that money isn't being put to work effectively. Lesson two, keep a close eye on that receivables trend. A 31% jump like that, that's a serious warning about the company's liquidity. And finally, lesson three, you've got to be careful valuing hybrid businesses like this. You just can't treat it like a normal manufacturer when so much of its fate is tied to the financial markets. So that leaves us with one final big question. After you strip everything away, what exactly are you looking at here? Is this a super conservative plastics company with a really strong balance sheet? Or is it actually a high-risk investment fund that just happens to have a manufacturing business attached?